For over a decade, the chart has mainly been characterized by an overall elongated uptrend. Usually there is one rapid bullish surge followed by an extended period of neutral to bearish movement. Even though this bullish reversal range is skewed, it has completed and has the primary characteristics of a double bottom. The only outstanding features are the two upswings are both from less strict piercing candle patterns. The second candles trade but do not close exactly at or above the halfway point of the first candles. Nonetheless, the upswing points are relatively aligned within the same range and produce strong short-term bullish movement. After the initial breakout from the double bottom, the uptrend remains intact but has slowed considerably. Regular bullish retracements stabilize the trend for a more gradual rise. The early ascending triangle had failed after bearish volatility contributed to a sharp double top in early 2014. However, long-term bearish sentiment held. Then a new incline was eventually able to surpass the extra-wide upper boundary of a successful ascending triangle. This wider upper boundary was due to resistance from the double top range. After a characteristic bullish acceleration, the first half of 2015 slows down for another period of constant swing points on a stable incline. Long-term uptrend lines from the double bottom and ascending triangle will certainly be helpful in the event of a significant downtrend. A compact double top demonstrates a bearish pattern, correcting the uptrend through stabilizing bearish retracements. Into November, there is more of this chart's characteristic movement with a short-term bullish spike followed by relatively low activity. Since the head and shoulders is inclined, it doesn't immediately provide a horizontal neckline area to reference with certainty. When the early September downswing and late May upswing align around 1946, a more precise horizontal neckline area is identified. Since the recent uptrend can't fully clear the full head and shoulders range, the 19 range will become an area of immediate support to reference. The range certainly does provide immediate support, but it is temporary. The medium and long-term conditions, along with short-term 3 methods falling price action, contribute to an accelerating drop. The bearish reversal is a more gradual triple top with some head and shoulders features, though certainly not a strict head and shoulders. Especially with the wide inclined neckline, it is imprecise due again to only one clear shoulder upswing point to reference. In this case, there is only a clear upswing to reference for the left shoulder. As the long-term uptrend accelerates, it is clear the bearish reversals of the past 2 years around the 19 range have generally been progressively weaker. Now the old early 2017 double top range will become the first major long-term support to reference. After a familiar long-term bullish surge, the chart has a normal neutral to bearish phase. However, a definite incline begins to emerge to avoid the formation of a double top reversal. A triple top reversal is possible, but the general incline should also be considered. Naturally, the 21 range provides firm support, but the downtrend is evidently sustainable as it gradually accelerates lower. Interestingly, the 21 range is also the site of a brief period of indecision on the 12th and 13th of March. The bearish star and doji represented a very short-term bearish to neutral pause. With the benefit of hindsight, the overlapping influence of 3 patterns is more clearly seen. First, there was a familiar failed ascending triangle from a triple top. Then, towards May, there was a very compact descending triangle that was harder to spot. During its development, this led to a classic bearish acceleration that was also quite stable and sustainable, as it wasn't composed of exceedingly large red candles, but rather a series of small red candles for a more stable but still rapid decline into the 21 region. The major influence of the 21 range widens the lower boundary of the descending triangle that is currently in the process of completing with a normal bearish acceleration. The late September highs never decisively cleared the downtrend line for a conclusive bullish continuation and failed descending triangle, though they did detract from the original outline and called for the new adjustment that more accurately identifies the declining trajectory and encompasses all three primary downswing highs. The downtrend lines are simply regular downtrend lines, and not from any pattern. They provide guidance on the progress of the bullish reversal after support holds in the old 19 range. Even though the main outline of the triangle has been passed, the support base and old 21 range will still provide considerable resistance. This is a case where a descending triangle's base and the pattern is less effective to use. The upswing in September back into the triangle outline did lower the pattern's ease of use, but bearish continuation context was maintained as the downtrend line wasn't conclusively passed. The pattern became more practical to use as a clear reference for first resistance in early 2021.